Warren Buffett. How to manage your money like the 1%. Proven strategies for financial success. Hello and welcome to our channel. Today, we're diving into the financial wisdom of Warren Buffett, one of the wealthiest and most successful investors in history. Known as the Oracle of Omaha, Buffett has a net worth of over $100 billion and is renowned for his simple yet effective approach to money management. In this video, we'll explore how you can manage your money like the top 1% by following Buffett's proven strategies. Whether you're aiming for financial independence or just looking to improve your financial habits, this video is packed with valuable insights. Let's get started. Part 1. Live below your means. One of Warren Buffett's core principles is living below your means. Despite his immense wealth, Buffett is known for his frugality. He still lives in the same modest house he bought in 1958 and drives a reasonably priced car. Living below your means involves spending less than you earn and avoiding unnecessary debt. This simple but powerful habit helps you save more money, which can then be invested to grow your wealth. Key points. Avoid lifestyle inflation. As your income increases, resist the temptation to increase your spending proportionally. Focus on needs over wants, prioritize essential expenses, and be mindful of discretionary spending. Create a budget. Track your income and expenses to ensure you're living within your means. Part 2. Invest in yourself. Buffett often emphasizes the importance of investing in yourself. This includes gaining knowledge, improving your skills, and maintaining your health. By enhancing your abilities and well-being, you increase your earning potential and overall quality of life. Key points. Education. Continuously seek to learn and grow, whether through formal education, reading, or online courses. Health. Take care of your physical and mental health through regular exercise, a balanced diet, and sufficient rest. Networking. Build relationships with others who can provide support, advice, and opportunities. Part 3. Understand the power of compound interest. One of the most powerful concepts in Buffett's investment philosophy is compound interest. Compounding occurs when the returns on your investments generate their own returns, leading to exponential growth over time. The earlier you start investing, the more you can benefit from compounding. Key points. Start early. The sooner you begin investing, the more time your money has to grow. Reinvest earnings, reinvest dividends and interest to maximize the effects of compounding. Be patient. Allow your investments to grow over the long term without frequent trading. Part 4. Value investing. Buffett is a proponent of value investing, which involves buying stocks that are undervalued by the market. By purchasing these stocks at a discount, you create a margin of safety and increase the potential for significant returns. Key points. Research. Conduct thorough research to identify undervalued stocks with strong fundamentals. Intrinsic value. Determine a stock's intrinsic value based on its earnings, assets, and growth potential. Long-term perspective. Invest with the intention of holding for the long term, allowing the stock's true value to be realized. Part 5. Diversification. While Buffett is known for making large, concentrated bets on a few companies, he also recognizes the importance of diversification for most investors. Diversifying your portfolio across different asset classes and sectors can reduce risk and protect your investments from market volatility. Diversification is a fundamental principle in investing that involves spreading your investments across different assets, industries, and geographical regions to reduce risk. The core idea is simple: don't put all your eggs in one basket. When you diversify your portfolio, you protect yourself from the potential poor performance of a single investment. For example, if you invest only in technology stocks and the tech sector experiences a downturn, your entire portfolio could suffer. However, by also investing in other sectors like healthcare, finance, and consumer goods, you can offset losses in one area with gains in another. Diversification not only mitigates risk but also enhances the potential for returns. Different asset classes and sectors perform well at different times. By holding a mix of stocks, bonds, real estate, and other investments, you increase the likelihood of benefiting from market upswings in various areas. Geographical diversification is another critical aspect. Investing in international markets can provide exposure to growth opportunities that may not be available in your home country. It also helps protect your portfolio from country-specific risks such as political instability or economic downturns. In essence, diversification is about balance and protection. It ensures that your investment portfolio is not overly reliant on any single asset, sector, or region. By spreading your investments, you can achieve more stable and consistent returns over the long term, making diversification a powerful tool for managing risk and building wealth. Key points: spread risk. Invest in a mix of stocks, bonds, real estate, and other assets to reduce the impact of any single investment's poor performance. Sector diversification. Ensure your portfolio includes investments from various industries to avoid sector-specific risks. Regular review. Periodically review and rebalance your portfolio to maintain diversification and alignment with your financial goals. Part 6. Emergency Fund. Buffett advises having an emergency fund to cover unexpected expenses. An emergency fund provides financial security and prevents you from dipping into your investments or going into debt when unforeseen costs arise. Key points: save 3-6 months' worth of expenses. Set aside enough money to cover your living expenses for several months in case of emergencies. Keep it liquid. Store your emergency fund in a readily accessible account, such as a savings account. Avoid using it for non-emergencies. Only tap into your emergency fund for true emergencies to ensure it's available when you need it. Part 7. Avoid debt. Buffett is known for his aversion to debt. While some debt, like a mortgage, can be considered good debt, high-interest debt, such as credit card debt, can be detrimental to your financial health. Key points: minimize high-interest debt, pay off credit card balances, and avoid taking on new high-interest debt. Use debt wisely. If you must use debt, ensure it's for investments that have the potential to generate returns, such as education or property. Live within your means. Avoid borrowing money for discretionary expenses and focus on saving for purchases. Part 8. Philanthropy and Giving Back. Buffett believes in the importance of giving back and using wealth to make a positive impact. He has pledged to give away the majority of his fortune to charitable causes and encourages others to consider philanthropy as part of their financial strategy. Key points: charitable giving. Donate to causes you care about and consider establishing a giving plan. Volunteering. Contribute your time and skills to organizations that need support. Legacy planning. Consider how you want to be remembered and plan your giving accordingly. Part 9. Continuous learning. Buffett is a lifelong learner and spends a significant amount of time reading and staying informed about the markets, businesses, and economic trends. Continuous learning helps you make informed financial decisions and adapt to changing circumstances. Key points: read regularly, consume books, articles, and reports on investing, finance, and business. Stay informed, follow financial news and market developments. Reflect on experiences, learn from your financial successes and mistakes to improve your strategy. Part 10. Long-term focus. Buffett's investment philosophy is centered on a long-term perspective. He advises investors to focus on the long-term potential of their investments rather than short-term market fluctuations. Key points: patience. Allow your investments to grow over time without being swayed by short-term market movements. Ignore the noise. Avoid making decisions based on daily market news and focus on the fundamentals. Stay the course. Stick to your investment strategy, even during periods of market volatility. In summary, managing your money like Warren Buffett involves living below your means, investing in yourself, harnessing the power of compound interest, practicing value investing, diversifying your portfolio, maintaining an emergency fund, avoiding debt, giving back, continuously learning, and maintaining a long-term focus. By adopting these principles, you can achieve financial success and build lasting wealth. Thank you for watching. If you found this video helpful, please give it a thumbs up, subscribe to our channel, and hit the notification bell for more financial tips and strategies. Leave a comment below with your thoughts or questions, and we'll see you in the next video. Stay tuned for more insights and strategies to help you on your journey to financial independence. Click on the next video for additional content. Happy investing!